And what we're going to talk about is rising inflation may not kill stocks. That's the message that I am thinking about and kind of debating about these days. I think it's important to look at particularly the US market and say, well, you could argue that this US market is really expensive, but you could also argue that the US market is split between what is highly valued, let's say, tech stocks versus the rest of the economy, which is actually kind of slowly coming back. So when I look at the overall US market, I see some risks, obviously, in valuation, but I want to think about inflation a bit. So if anybody's got a question, you can ask it as I go through this, and I'll do my best to try to answer it. But what I'm going to do is talk about the article of the day that I've just been looking at. And the article is, "The bond market is betting on a red-hot economy and stocks don't like it." So this article talked about how investors seem to be waiting for the Fed's next moves, and how growing inflation concerns and economic optimism has led interest rates to rise in the US in particular, but we've also seen it in Thailand. And investors fear that inflation could cause the Fed to start tightening, to start to reduce inflation. And so they're trying to understand what the impact on the stock market is, which I'll talk about in a moment. But let's continue on this particular argument in this article. Basically, the idea is a tight monetary policy would hurt the stock market. If the US started to increase interest rates, in theory, it's going to hurt the stock market. So rising interest rates means investors use a higher discount rate to value stocks. It also means the cost of debt for companies is rising, and therefore it would technically hurt stocks. Of course, even if rates rise, they're still really low. I mean, think about how many people were asking in the past couple of years, how do we value companies when interest rates are zero? But interest rates, even if they rise, they're pretty low. So the other constraint on rising interest rates, particularly in the US, is the US budget deficit. And that is because interest costs now are massive as a percent of total spending of the US government. And if interest rates went up, it could cause a doubling. If interest rates just went from 1% to 2%, it could cause a doubling in the amount of that the government's spending on interest. And the reality is that if that happens, then it's really painful. And I think that's part of the biggest reasons why the Fed and the Treasury is going to try to step in. So as interest rates start to rise, I expect that the US government will probably come in with some type of way of trying to bring down the interest rates, which I'll talk about in a bit. So let's talk about the topic of today. The topic is the real return of investments in Thailand over the past 20 years. What is it? Well, I did some calculations to try to look at that, and I'll be talking about that for a moment. But let's just look at the impact of inflation on money value. It's often neglected by investors. They forget about it. But purchasing power is adversely affected by inflation. In other words, when inflation rises, the value of your money falls. Hence, investors really should be looking at inflation-adjusted returns. So let's look at that in a little bit more detail. To calculate this inflation-adjusted returns, or we can call it real returns, first of all, remember that bond yields are always expressed in nominal terms. That means it includes inflation. To calculate the real return, we can apply what's called the Fisher equation, where we just look at nominal rates and we reduce nominal rates by the amount of inflation. Now, what I've done is I've done a little study where I went back to 2001 in Thailand, and I said, what if an investor they held their money in cash, they put it in 3-month fixed deposit, 12-month fixed deposit, or a Thai government bond. And what we can see is over 10 years, if you put money, $100 or 100 baht in a bank at 3 months or at 12 months, you're going to end up with about 140 baht of the 100 that you put in. But if you had put that money into Thai government bonds, you would have had a return of 213. So that means the 100 that you initially put in plus another 113 in gain over 10 years. So what we can see is that obviously, if you had a choice between keeping it in cash at the bank or putting it in government bonds, you would choose government bonds. However, once we adjust for inflation, that 113% bond return comes down to about 46%. It's still positive, but it's much lower. And when we look at the fixed deposits basically barely kept up. They ended up at between 91 and 99, depending on the term. So in other words, your money did not outpace inflation when it was at the banks. And of course, if you didn't earn anything at the banks, then your money actually lost value over that time. So now let's add into this the idea of the stock market. And so imagine that you put 100 in the stock market. Remember that we said on a real basis, a real return basis, we can see that the bond market was up 146. That was the increase, right? Because you put in 100 and you end up with 146. And the stock market was up 600 after inflation. The point being is that if you're worried about inflation, one of the most valuable places to be, besides, okay, you could be in, let's say that you're in commodities, you're in maybe land and fixed assets. Those are valuable things when inflation is rising. And we've already talked about those a bit in the last time that I came on. But here, what I'm saying is that equity and investing in stocks is not a bad thing to do during the time that we have inflation. Why is that? Well, the reason why I like equity during time of inflation is because you're buying into a management team and a CEO of that company who's trying everything they can to try to outpace inflation. And the result of that is that by trying to outpace inflation, hopefully they're going to achieve it. So I would say that equity is probably more attractive relative than bonds, certainly during a time of high inflation. Now, I was looking at the meme of today, and it was somebody talked about EBITDA. You all know EBITDA, earnings before interest, depreciation, taxes, depreciation, and amortization. But this was earnings before interest, taxes, depreciation, amortization, and coronavirus, which was a pretty funny meme. Now, I also just wanted to take a moment to talk about one of my podcast guests. His name is Junaid Iqbal, and I recently interviewed him about some crypto investment. Now, Junaid's an interesting guy because he started a website called nodegree.com. And I just think it's fascinating because he's trying to provide a website for people who don't have degrees to be able to get jobs. So I really love what he's doing there. And basically, he invested about $800 in Bitcoin when he was in college. He was lucky enough to sell when the price was high, just before it crashed. But you fast forward to 2017, and Junaid decided to use his credit card to invest $20,000 in several different cryptocurrencies, and he lost it all 2 months later, and he's still paying for it on his credit card. So this was one story of loss in my worst investment ever. So let's just review what we can learn from his story. First of all, only invest what you can afford to lose, especially when it comes to crypto, because it just is so volatile. In the past, I've talked about the idea if you're going to add crypto to your portfolio, between 1% and 3% may be a good starting point until you really get a handle on how you're going to manage the risk of that. And start small and invest maybe 70% of your money in something like Bitcoin, maybe divide the other 3 based upon market cap into the other 3 cryptocurrencies. That's one idea about how to do it. So that's some of the things that I learned from this discussion with Junaid. So to wrap up, my conclusions, the key points of what I wanted to say today is investors fear that inflation will arrive too fast, and they fear that the Fed can't maintain its current expansionary policy. In Thailand, deposits were not able to preserve real money value. Bonds did okay, but of course, equities do a lot better. So in a time of rising inflation, of course, we like commodities in like land, physical assets, but also the equity market, because you're investing in all of these different types of CEOs and management teams, you get to get exposure to that. And so equities is not so bad during that time. So I just wanted to also highlight for those who want to learn how I pick stocks, just you can download my checklist, which I think on the video is on in Clubhouse. It's not on, but I'm open if anybody has any questions. But that's the key of my points today about inflation. So I want to thank everybody for attending, and feel free if you have any questions. If not, I'm going to sign off and say, I hope you have a great trading day and another beautiful day in our life.